Bank account bonus is stacked 3,000 in 90 days. If your business bank account is sitting there doing absolutely nothing while banks are throwing hundreds of dollars at new customers, your money is basically leaving free cash on the sidewalk. And yes, I said hundreds. For a tiny business, $300 can pay for software, shipping supplies, a stack of invoices, a month of advertising, or enough coffee to keep you awake while you question every life choice that led you to entrepreneurship. Now imagine stacking several legitimate bank account bonuses and turning those small payouts into $3,000 over 90 days. That sounds wild. It also sounds like one of those internet schemes where a guy named Brad is standing beside a rented Lamborghini explaining how you can make $10,000 before lunch. Relax. We are not doing Brad economics today. We are talking about real bank account bonuses for real small businesses in the United States. And more importantly, we are talking about how people mess this up, because the bonus itself is usually the easy part. The hard part is reading the rules, timing your deposits, avoiding unnecessary fees, keeping enough cash available, tracking every requirement, and making sure your business is actually eligible. The first thing most people get wrong is thinking the bonus is free money with no strings attached. It is not. A bank bonus is usually a marketing expense paid by a bank to attract a new customer, but the bank wants something in return. Maybe it wants a qualifying deposit. Maybe it wants a certain average balance. Maybe it wants several debit card transactions. Maybe it wants qualifying purchases. Maybe it wants you to keep the account open for a certain period. Maybe it wants some combination of all of those things. The bank is not your rich uncle. The bank is running a business. You are running a business. Everybody is trying to win. And that is actually good news, because once you understand the rules, you can stop treating bank bonuses like random surprises and start treating them like a tiny business project. Think of each bank account bonus like a vending machine. You put the required ingredients into the machine. You follow the instructions. You wait for the machine to process everything. Then the machine spits out money. The mistake is shaking the machine because you are impatient. That is how people end up with fees, failed requirements, closed accounts, overdrafts, or a very uncomfortable phone call with customer service. So today we are breaking down the biggest mistakes people make when trying to stack bank account bonuses toward $3,000 in 90 days. We are going deep. We're getting practical. We are also getting slightly unhinged, because managing bank bonus requirements should not feel like filing taxes inside a haunted escape room. First, understand that the $3,000 goal is a target, not a promise. There's no universal bank bonus formula. Offers change, eligibility changes, geographic restrictions change, business types can matter, account types can matter, your previous relationship with a bank can matter, your deposit history can matter, your credit and banking history can sometimes matter. And the offer that looks perfect on Tuesday can disappear by Friday. That means your job is not to memorize one list of banks. Your job is to build a repeatable system. That system starts with research. Before opening anything, read the official bonus terms. Not a screenshot, not a social media post, not a random comment from somebody named Money Wizard 420. The official terms. You want to know what counts as a qualifying deposit. You want to know how long the qualifying period lasts. You want to know whether transfers from another bank count. You want to know whether transfers from another account at the same bank count. You want to know whether cash deposits count. You want to know whether payment processor deposits count. You want to know what fees apply. You want to know when the bonus is expected to arrive. You want to know whether the account has a minimum balance. You want to know whether the account has monthly maintenance fees. You want to know whether the bonus is limited to new customers. You want to know whether an old account makes you ineligible. And you want to know whether the bank defines a new customer differently from the way you would define one. This is where people get wrecked. They read the giant headline. They see a $500 bonus. Their brain starts playing victory music. Then they discover that the offer requires a qualifying deposit of $25,000. Suddenly the $500 bonus is looking less like a bonus and more like a hostage situation. The second mistake is chasing the biggest bonus instead of chasing the best bonus. Those are not always the same thing. Suppose Bank A offers $300 and requires $5,000 of qualifying deposits. Suppose Bank B offers $500 and requires $25,000. Which one is better? For a business with $25,000 sitting idle, Bank B might make sense. For a tiny business operating with $6,000 of available cash, Bank A could be dramatically better. The bonus percentage matters. Your liquidity matters. Your opportunity cost matters. Your risk matters. Your time matters. A small business owner should not move money around simply because a giant number appears in an advertisement. Cash flow is oxygen. Do not suffocate your business to collect a bonus. That brings us to the third mistake. People confuse available business cash with spare cash. Those are completely different things. If your business has $10,000 in the bank and you know $7,000 is needed for payroll, rent, taxes, inventory, and upcoming bills. You do not have $10,000 available for a bonus strategy. You have $3,000 that might be flexible. That distinction is everything. Imagine your business as a pickup truck. The cash in your operating account is the fuel. You can move fuel between tanks if the tanks are designed for it. But if you drain the truck just because somebody offers you a coupon, congratulations, you now own a very profitable vehicle that cannot reach the gas station. The fourth mistake is ignoring taxes. Bank bonuses can have tax consequences. Banks may report bonuses to the Internal Revenue Service depending on the circumstances and applicable rules. The exact tax treatment can vary. That means your bookkeeping should not treat every bonus as invisible magic money. Talk with your tax professional about how bonuses received by your business should be recorded and reported. For many small businesses, the amount involved may be modest, but modest amounts still deserve clean records. Your future self will thank you. Your accountant may also thank you. Your accountant is probably already stressed enough. Do not make them hunt for a $700 mystery deposit from a bank you opened 3 months ago. The fifth mistake is failing to track the bonus requirements. This one sounds painfully obvious, yet people still do it. They open an account, they make the deposit, then life happens. A shipment arrives, a client sends a late payment, the kids need something. Your phone starts yelling about storage, your email inbox becomes a crime scene. 3 weeks later, you realize the qualifying period ends tomorrow and you are missing one requirement. This is why every bonus should have its own tracking sheet or task list. You should know the bank, the account, the opening date, the offer expiration date, the required deposit, the qualifying period, the funding deadline, the minimum balance requirement, the expected bonus amount, the expected bonus date, the fee structure, the date you completed each requirement. On the date you plan to verify the bonus, you do not need fancy software. A spreadsheet works, a notebook works, a calendar works, even a very disciplined pile of sticky notes can work. Just do not rely on memory. Memory is fantastic for remembering the chorus of a song from 2004 and terrible for remembering whether a qualifying deposit must arrive within 30 days. The sixth mistake is assuming every transfer counts. This is one of the biggest traps. Banks can define qualifying deposits differently. An electronic transfer from an external financial institution may count for one offer. A transfer from another account at the same institution may not. A wire may count. A payment processor deposit may count. A mobile deposit may not. A cash deposit may not. An internal transfer may not. A check may or may not qualify. There is no universal rule. Read the terms. If the terms are unclear, contact the bank and ask. And when you contact the bank, document what you were told. Write down the date, write down the representative's name or identification if available. Save the chat transcript or email when possible. That way, if something goes sideways, you have a record of your understanding. Do not assume that a friendly sentence from a stranger on a forum overrides the actual terms of the offer. It does not. The seventh mistake is opening too many accounts at once. This is where bank bonus stacking can go from clever to clown show. One account is manageable, two can be manageable, 5 can become annoying, 10 can become a full-time job nobody hired you for. Every account creates administrative work. Every account has statements. Every account has login credentials. Every account has potential fees. Every account has requirements. Every account needs monitoring. And every account creates another opportunity for something to go wrong. Now, the goal is not maximum account count. The goal is maximum useful profit for reasonable effort. A small business owner should think about return on time. If a $300 bonus requires an hour of research, 20 minutes to open the account, and 10 minutes of monthly monitoring, that could be worthwhile. If the bonus requires 6 hours of administrative work, multiple calls, constant transfers, and a mountain of paperwork, maybe the economics are not as beautiful. You are running a business. Your time has value. The eighth mistake is forgetting about monthly fees. A $500 bonus can look fantastic. Then the account charge is $25 per month. You forget about the account for a year. Congratulations. The bank got the joke. You did not. Many accounts offer ways to waive monthly fees through qualifying balances, deposits, or other requirements. Know those rules. If the fee waiver requires a minimum balance, include that balance in your cash flow calculation. Do not mentally count that money as available if you need to keep it parked to avoid fees. A bonus strategy should be evaluated using net value. Bonus received minus account fees, minus transfer costs, minus other direct costs, minus meaningful opportunity cost. That gives you a much more realistic picture. The ninth mistake is ignoring early closure rules. Some bonus offers include language related to keeping the account open for a certain amount of time. Closing too early can create problems. The bank may not pay the bonus. The bank may claw back the bonus. The bank may charge a closure fee. Or the terms may simply make you ineligible for future offers. Again, read the actual terms. Do not assume that once the bonus bonus appears in your account, the game is finished. Sometimes the bank wants the account relationship to remain open. If you are planning to close an account after collecting a bonus, verify that doing so does not violate the offer terms. The 10th mistake is treating bank bonuses like guaranteed income. They are not. A business owner should never build payroll around a bonus that has not arrived. Do not schedule your rent around a bonus that might arrive next week. Do not order inventory because a bank promised you a payout. Do not tell your spouse that dinner is on the bank. The money is not real for your cash flow planning until the conditions have been met and the bonus has actually posted. That sounds boring. It is also responsible. And responsible money management is how you stay in business long enough to enjoy the fun stuff. Now let's talk about the actual stacking strategy. Suppose you identify several business checking or savings promotions that fit your situation. You could open them all immediately, but a better approach is sequencing. Start with the offer that has the shortest qualifying window or the highest priority. Complete its requirements. Document everything. Then move to the next offer. This reduces mental clutter. It also reduces the chance that multiple deadlines sneak up on you. Think of it like cooking dinner. You do not throw every ingredient into every pot at the same time and hope dinner eventually becomes lasagna. You follow the recipe, one step at a time, one account at a time, one requirement at a time. The 11th mistake is ignoring the source of your deposits. This matters because qualifying deposit definitions can exclude certain transactions. Some offers require new money. That phrase can be important. New money might mean funds that were not already held at the bank. If you move money from one account at the same bank to another, you might not satisfy that requirement. If you move money from an outside bank, you may. But once again, the exact definition belongs to the offer. Never assume. The 12th mistake is moving money too quickly. People see a deadline and panic. They transfer funds at 11:58 p.m. on the final day, then the transfer settles later. Now they are refreshing their banking app like it owes them rent. Timing matters. Transfers can take time. Weekends can affect processing. Holidays can affect processing. Cutoff times can matter. Some banks use business days. Some offers measure balances differently. The safest strategy is to complete requirements well before the deadline. Do not make the deadline your target. Make the deadline your emergency backup. The 13th mistake is misunderstanding business eligibility. Not every business qualifies for every business account. Some banks have rules about entity type. Some may require an employer identification number. Some may accept sole proprietors under a personal name. Some may require business documentation. Some may ask for formation documents. Some may ask for identification. Some offers may exclude certain business categories. Your business structure matters. Your documentation matters. Your existing banking relationship may matter. Before applying, make sure you can provide accurate information. Never misrepresent your business just to qualify for a promotion. A $300 bonus is not worth turning a simple banking relationship into a paperwork nightmare. The 14th mistake is mixing personal and business money. If you operate a business, keeping business finances organized is important for bookkeeping and financial clarity. A business account can help separate business transactions from personal spending. That separation can make your life easier when reviewing expenses, preparing reports, and working with a tax professional. The bank bonus should be a side benefit of a sound banking strategy. It should not be the reason you create a ridiculous financial maze. If you have 10 accounts and cannot remember which one pays the electric bill, the strategy has officially jumped the shark. The 15th mistake is ignoring account limits. A bonus account can be useful for qualifying deposits, but it may not be the best primary operating account. You might prefer a different account for payroll. Another might be better for cash deposits. Another might offer better integrations. Another might have stronger online banking tools. Another might have lower transaction costs. The bonus account does not need to become your entire financial universe. Treat each account according to its purpose, and that is one of the secrets of successful stacking. You are not collecting bank accounts. You are assigning jobs to financial tools. The 16th mistake is failing to calculate opportunity costs. Imagine you move $10,000 into a promotional account to earn $300. If that money could have generated meaningful value somewhere else, the bonus has a cost beyond the obvious bonus fees. Maybe the money was needed for inventory. Maybe it could have reduced expensive debt. Maybe it could have stayed in a higher yielding account. Maybe it could have covered a seasonal cash crunch. A bank bonus is only attractive when the underlying economics make sense. $300 sounds amazing until you realize you had to freeze $20,000 for 6 months to get it. That could be a terrible deal, or it could be a great deal. It depends on your situation. This is why the correct question is not how big is the bonus. The better question is, what am I giving up to earn the bonus? The 17th mistake is believing bigger businesses automatically win. Not necessarily. A micro business can sometimes be extremely flexible. If you have a few $1,000s of genuine excess cash, a handful of well-chosen promotions can produce meaningful incremental income. A large company may have more money, but also more complexity. The beauty of a micro business is that the owner can often make decisions quickly. You know where the money is, you know which bills are coming, you know which customers pay late, you know whether next month will be ugly. Use that knowledge. Do not copy a strategy designed for a company with $10 million in cash if you are operating a business with $10,000. Different animals, different cages, different snacks. The 18th mistake is believing every online bonus strategy is current. Financial promotions change constantly. An article published years ago might still rank highly in search results. A video might show a promotion that expired months ago. A forum comment might reference an offer that no longer exists. Even a bank's own website can have multiple promotions with different eligibility rules. Always verify the current terms before acting. This is especially important if you are building a 90-day challenge. Your strategy should be based on offers available when you actually apply, not offers somebody remembers from 3 summers ago. The 19th mistake is forgetting that offers may be targeted. Some promotions are available broadly. Others may appear only through certain links, invitations, direct mail, email, or online banking dashboards. That means 2 customers can see different offers. If you find a promotion online, verify that you are actually eligible for the version you are seeing. Do not assume a screenshot proves you will receive the same deal. The 20th mistake is confusing a bank's marketing language with its contractual requirements. Marketing is designed to get your attention. Terms are designed to define the deal. The giant number gets you through the door. The small print tells you what you actually have to do. That is not necessarily sinister. It is how promotions work. But you need to read both. A smart business owner can appreciate the marketing while respecting the fine print. Now let's talk about the 90-day challenge itself. If your target is $3,000, you need a scoreboard. Without a scoreboard, the challenge becomes vibes. Vibes do not pay invoices. Create a running total. For example, if the first bonus posts at $500, your remaining target is $2,500. If another bonus posts at $750, you are at $1,250 earned. You can track pending bonuses separately. That distinction matters. Pending is not earned, expected is not earned, promised is not earned, posted is earned. That little rule can save you from spending money that does not yet exist. Your scoreboard can have 3 simple categories: potential, pending, received. Potential means you have identified an offer but have not completed the requirements. Pending means you completed the requirements and are waiting for the bonus. Received means the money has actually posted. That system gives you a clear picture. Now here is where things get interesting. You do not necessarily need 10 bonuses. You need enough profitable bonuses to reach the target. If you find 6 offers averaging $500, you theoretically have $3,000. But that does not mean all 6 will be available to you. One could have geographic restrictions. One could require a larger balance. One could require a specific business type. One could have a deadline that does not fit your 90-day window. One could have a relationship restriction. One could disappear. That is why flexibility matters. Build a pipeline. Do not build a single point of failure. If your entire plan depends on one $500 offer, you do not have a plan. You have a hope. A pipeline might include more offers than you actually need. Then you select the best ones based on your available cash and business needs. This is similar to sales. A salesperson does not expect every prospect to close. They build a pipeline. You can think about bank promotions the same way. Research, qualify, prioritize, apply, complete, track, receive, review, repeat. That is the engine. Now let's talk about cash flow, because this is where small businesses live or die. Suppose your business receives $5,000 this week. You might look at that number and think you have $5,000 available, but maybe $2,000 goes to inventory. Maybe $1,000 goes to payroll. Maybe $500 goes to taxes. Maybe another $500 covers software, rent, insurance, and other expenses. Now you have $500 of genuine flexibility. That $500 might be useful for a bonus requirement, or it might need to stay liquid The point is that bank bonus strategies must fit into your cash flow calendar. Look ahead. When are your biggest expenses? When do your customers typically pay? When are taxes due? When does payroll hit? When do suppliers require payment? When does your business become seasonally slow? Once you understand that calendar, you can identify cash that can safely be moved. This is one of the most valuable habits in small business finance. You are not just asking, where is my money? You're asking, when will I need my money? That second question changes everything. Now let's talk about fees in more detail. Suppose an account charges a monthly fee unless you meet a condition. You need to know exactly how the condition is measured. Maybe the bank uses a daily balance, maybe it uses an average monthly balance, maybe it requires qualifying deposits. Maybe there are multiple ways to waive the fee. Do not guess. Read the current fee schedule. Then build a fee waiver into your plan. If you must maintain a certain balance, mark that amount as restricted. Do not count it twice. This is basic accounting logic. Money can have a job. $1 cannot simultaneously serve as your emergency reserve and your qualifying balance if you need to withdraw it to handle an emergency. Money is flexible. But it is not magic. The same dollar cannot be everywhere at once. Now let's talk about account bonuses and your banking history. Banks may evaluate applicants using information from various sources and their own internal policies. Banking history can matter. Prior account closures can matter. Outstanding issues can matter. The exact factors vary by institution. This is another reason not to treat bonus stacking as a game where you aggressively open every account you can find. Your long-term banking relationship has value. If you constantly open accounts, collect bonuses, and close everything immediately, you may create a pattern that does not fit every institution's preferences. There is no universal rule saying banks will punish you. There is also no universal rule saying they will love it. Use judgment. Your business should have a stable banking foundation first. Bonus hunting comes second. That order matters. The 21st mistake is letting the bonus distract you from better financial opportunities. If your business has expensive debt, a $300 bonus may be less important than reducing interest costs. If you have no emergency reserve, building one may be more important. If your business needs equipment that will increase revenue, investing in that equipment may create more value. If your marketing is producing strong returns, funding it may be more profitable. A bank bonus is one tool. It is not the whole toolbox. This is why I like the phrase bonus stacking rather than bonus chasing. Stacking suggests strategy. Chasing suggests panic. You want strategy. The 22nd mistake is assuming a bonus is worth pursuing simply because it is easy. Sometimes an easy bonus is not the best bonus. Maybe the payout is small. Maybe the account has fees. Maybe the account does not fit your operations. Maybe you already have too many accounts. Maybe your time would be better spent closing one additional customer. If you can spend an hour earning $300, that can be fantastic. If you can spend that same hour closing a $5,000 client, the choice becomes different. Your opportunity cost is real. The best bonus strategy is not the one that maximizes bank bonuses. It is the one that maximizes your business outcome. The 23rd mistake is ignoring documentation. Save offer details. Save confirmation emails. Save screenshots when appropriate. Save account opening information. Save deposit records. Save statements. Save evidence that requirements were met. This is not paranoia. This is organization. Banks handle millions of transactions. Humans make mistakes. Systems make mistakes. Promotions can be complicated. If a bonus does not appear, you want evidence. You should be able to say what offer you used, when you opened the account, what you deposited, when you deposited it, and why you believe the requirements were satisfied. That turns a frustrating phone call into a much easier conversation. The 24th mistake is assuming customer service will automatically fix everything. Customer service can be helpful, but you should still know the facts. If you call and say, I think I was supposed to get a bonus, that is vague. If you say, I opened the account on this date under this promotion, deposited the required amount on this date, maintained the required balance, and the terms state the bonus should post within this period, that is much stronger. Be polite, be specific, be patient, and keep records. Savage does not mean rude. You can fight for your money without acting like a villain in a courtroom drama. The 25th mistake is overlooking the value of business savings accounts. Many people focus entirely on checking account bonuses. Savings promotions can also exist. The requirements can differ. The economics can differ. If your business maintains a genuine reserve, a savings promotion may sometimes fit naturally into your strategy. But again, do not move operating cash just because a savings bonus looks shiny. Your emergency fund has a purpose. Do not turn it into a treasure hunt. The 26th mistake is forgetting about transaction limits. Some accounts may have limits, fees or restrictions associated with certain transaction types. For a micro business, that can matter. If you process a high volume of transactions, an account designed for a small number of transactions might not be a good operational fit. If your business receives cash frequently, access to convenient branches or cash deposit capabilities could matter. If you operate almost entirely online, digital banking features might matter more. The bonus is only one part of the account. The account itself has to work. The 27th mistake is letting the bonus strategy damage your bookkeeping. Every new account means more reconciliation. Every transfer creates another transaction. Every bonus creates another line item. If your bookkeeping system is already messy, adding 6 accounts may make it worse. You need to know where money came from and where it went. Your book should still make sense after the challenge ends. If you cannot reconcile the accounts, the bonus strategy has become an administrative liability. The 28th mistake is ignoring security. More accounts mean more passwords. More passwords mean more opportunities for weak security. Use strong, unique credentials. Enable multi-factor authentication where available. Keep recovery information secure. Be careful with phishing messages. Banks will never make your bonus strategy safer by sending you a suspicious link at midnight. If you receive a message claiming you must immediately verify your banking information, slow down. Go directly to the bank's official website or app. Do not click random links. A $300 bonus is not worth losing $30,000. The 29th mistake is thinking international viewers can copy every United States strategy exactly. This series is focused on the United States. Banking rules vary by country. Tax rules vary. Consumer protections vary. Business structures vary. Deposit insurance systems vary. Promotional rules vary. If you are watching from outside the United States, use the concepts as education rather than assuming the specific offers apply to you. The broader lesson is universal. Financial institutions spend money to acquire customers. Businesses can compare incentives. Read the rules, calculate the economics, protect liquidity. Track everything. That concept travels. The exact bank promotion does not necessarily travel with it. The 30th mistake is thinking the bank bonus itself is the business model. It is not. The business model is still your product or service. The bonus is an optimization. That distinction keeps you grounded. If your business makes $10,000 a month and you add $3,000 of legitimate bank bonuses, fantastic. If your business loses $5,000 a month and you celebrate $3,000 of bonuses, you have a different problem. Bonuses can improve economics. They cannot rescue a broken business model indefinitely. Now let's talk about the psychological side. Money bonuses trigger excitement. Excitement makes people move faster. Fast decisions can be useful. They can also be stupid. When you see a promotion, give yourself a cooling off period. Read it, calculate it, compare it, then decide. You do not have to chase every deal. Some offers are designed to create urgency. That does not mean you need to panic. If an offer ends tonight and you have not had time to read the terms, maybe you miss it. That is okay. There will be another promotion. There may not be the exact same promotion, but there will likely be other opportunities. Your business should survive the weekend. The 31st mistake is failing to rank opportunities. Give each offer a score. You can think about bonus size, cash requirement, time requirement, fee risk, complexity, business fit, liquidity impact, account usefulness, eligibility confidence. Then prioritize. A $300 offer with low complexity and low cash requirements may beat a $700 offer with huge cash requirements and complicated rules. This is where a micro business owner can think like an investor. You are allocating scarce resources. Your resources include cash, time, attention, administrative capacity, risk tolerance. The best opportunity uses those resources efficiently. The 32nd mistake is assuming that moving money is free. Depending on the transfer method and accounts involved, there can be costs, there can also be delays, there can be limits, there can be wire fees, there can be expedited transfer fees, there can be opportunity costs. Before moving money, understand the mechanics. A bonus should not become a transfer fee festival. If you pay $50 in fees to earn $100, your victory dance needs a much smaller budget. The 33rd mistake is failing to monitor the account after the requirements are complete. You finish the deposit, great. Now monitor, confirm the balance requirement, confirm the account remains open, confirm no unexpected fee appeared, confirm the bonus posts, confirm the bonus amount, then update your records. Do not disappear after completing the first step. The final mile matters. The 34th mistake is assuming the advertised bonus will arrive instantly. Promotions can have processing periods. Some bonuses may post after the qualifying period ends. Others may take additional time. Read the terms. Do not panic because the bonus did not appear the next morning. At the same time, do not wait forever. If the stated processing period has passed, contact the bank. Again, documentation is your friend. The 35th mistake is closing accounts before verifying everything. If you close an account immediately after completing the deposit requirement, you could create unnecessary complications. Wait until the terms allow closure. If closure is your plan, confirm the bonus, confirm any clawback period, then decide whether the account still serves a purpose. Sometimes keeping the account open makes sense, sometimes it does not. The right answer depends on the economics and terms. The 36th mistake is treating all bank relationships as interchangeable. They are not. One bank may be excellent for branch access, another may have strong online tools, another may be attractive for a bonus, another may have better business credit products, another may integrate well with your accounting software. A smart banking setup can involve multiple institutions, but every additional institution creates complexity. Again, balance. You want a financial system. You do not want a financial junk drawer. The 37th mistake is ignoring the future value of a banking relationship. A bank may eventually offer lending products, business cards, treasury tools, merchant services, or other products. Your relationship can matter. That does not mean you should stay with a bad bank forever because you are afraid to lose a relationship. It means you should consider more than the immediate bonus. If two offers are similar, the institution that provides useful services for your business may have more long-term value. The 38th mistake is forgetting that your business may grow. An account that works when revenue is $5,000 per month may become frustrating when revenue reaches $50,000. Think about scalability. Will the transaction limits work? Will the online banking tools work? Will the account support additional employees? Will you need multiple users? Will you need better reporting? Will the bank support your future needs? A bonus is short-term. Your business is hopefully long-term. The 39th mistake is believing that complicated always means sophisticated. It does not. Sometimes the smartest strategy is simple. One operating account, one reserve account, one promotional account, a clear cash flow plan, a clean spreadsheet. Done. You do not get extra points for creating a financial Rubik's Cube. Complexity is not sophistication. Clarity is sophistication. The 40th mistake is not reviewing the strategy after 90 days. At the end of the challenge, calculate your actual results. How much did you earn? How much did you spend? How many hours did you invest? How much cash was tied up? How many accounts did you open? How many accounts did you keep? What went wrong? What worked? What would you repeat? What would you never do again? That is how a challenge becomes a system. You are not just trying to make $3,000. You are learning how to optimize your business finances. Now let's get more practical. Imagine you have a micro business with $12,000 in total cash. $4,000 is needed for near-term operating expenses. $3,000 is your emergency reserve. That leaves $5,000 that might be flexible. You discover a promotion requiring a qualifying deposit of $5,000. At first glance, perfect. But before moving the money, you ask whether the account has fees. You check whether the deposit qualifies. You check the deadline. You check whether the money needs to remain there. You check whether your existing relationship makes you eligible. You check whether the account works for your business. Then you compare the offer with alternatives. Maybe another promotion requires only $2,000 and pays $200. Maybe the $5,000 offer pays $500, which is better. You calculate the return relative to the cash requirement. You also consider liquidity. If the $5,000 offer locks up your entire flexible cash reserve, perhaps the $2,000 offer is safer. This is the difference between chasing money and managing money. The 41st mistake is assuming a higher bonus always means a higher return. A $500 bonus on $25,000 is a 2% incentive. A $300 bonus on $5,000 is 6%. Those numbers are not the entire story, but they illustrate why percentage matters. You should also consider how long the money must remain there. A 2% return for a short period can be attractive. A 2% return requiring a long commitment may be less exciting. The annualized economics can differ. You do not need to become a Wall Street quant. You just need to ask sensible questions. How much cash? How long? How much bonus? What fees? What risk? What work? What alternatives? The 42nd mistake is ignoring interest. Some accounts may pay interest, others may not. If your money is going to sit somewhere anyway, the interest rate can affect the total value. You might compare the promotional bonus plus interest with another account offering a higher ongoing yield. Again, do not let the bonus number blind you. The total financial outcome matters. The 43rd mistake is forgetting that taxes can affect the net value. Suppose you receive a bonus and owe taxes associated with it. The headline number is not necessarily your after-tax number. Your tax situation depends on your business and applicable rules. A tax professional can help determine the correct treatment. For planning purposes, you can simply remember that the amount landing in the account is not always the same as the amount you should mentally treat as pure profit. Keep records. Stay organized. Do not spend the entire bonus before your books are updated. The 44th mistake is spending the bonus emotionally. You finally receive $500. You feel like a financial genius. Then you immediately order a fancy gadget. Congratulations. Your bank bonus became a shopping spree. Instead, decide ahead of time what the bonus will do. Maybe it goes into your emergency reserve. Maybe it pays for software. Maybe it funds marketing. Maybe Maybe it covers a business expense. Maybe it becomes retained earnings. Maybe you take a small portion as a reward. There is nothing wrong with enjoying the win. Just make sure the win actually improves your financial position. The 45th mistake is failing to build a cash buffer before starting. Bonus stacking is much easier when your business has breathing room. If every dollar is already committed, promotional requirements become stressful. If you have a reserve, you can move money strategically. That is why I would rather see a business owner build a healthy emergency cushion before aggressively chasing bonuses. A bonus is an optimization layer. A cash reserve is a survival layer. Survival comes first. The 46th mistake is treating promotional terms like suggestions. They are not. If the terms say qualifying deposits must total a specific amount, hit that amount. If they say the money must remain for a specific period, respect it. If they exclude certain transactions, do not assume the bank will make an exception. You are entering a financial contract governed by the applicable account agreement and promotion terms. Read them. This is not the place for vibes. The 47th mistake is failing to verify the offer before applying. Sometimes advertisements can have expiration dates. Sometimes the offer changes. Sometimes a public page is different from a targeted offer. Sometimes the bonus requires a promotional code. Sometimes the code must be entered during application. Sometimes the offer is only available through a specific channel. Verify everything before opening. A screenshot can be useful for your records, but the official terms are what you need to understand. The 48th mistake is assuming that a rejected application means you should keep applying everywhere. Slow down. A rejected application can have many possible reasons. Instead of opening 5 more accounts in frustration, review what happened. Maybe you were not eligible. Maybe the business information did not match. Maybe documentation was missing. Maybe the bank has internal policies you cannot see. Do not turn frustration into financial chaos.